Let's now dig deeper into the risks associated with the financial stability due to the pandemic shocks on the economy. Vice Governor of the National Bank of Georgia, Papuna Lejava, also sat down with the checkpoints this week. With him, we will be focusing on four main risks to financial stability as identified by the NBG. These are uncertainty associated with the duration and economic impact of COVID-19 pandemic, increase in country risk premium and its repercussions on exchange rate and foreign currency debt burden, more than anticipated adverse impact of the weaker external demand and the virus containment measures on tourism and its adjacent industries, and finally, drop in real estate prices due to weak demand and its adverse impact on the financial sector. I won't talk much to Georgi. Papuna Lejava will explain more for our viewers. First risk that is mentioned, these are the risks associated with the length of the pandemic and how it is really tough to predict how long COVID-19 will take, and also impact of it on the economy. Why is it a risk? And this question rises because we see that the government has a firm position that further lockdowns are no more issue.
Thank you, Elena. Great question, and thank you for covering this report. Let me summarize the key messages from the report. First, how we approach this crisis. The financial sector and the banking sector was much better prepared for this crisis than for the previous crisis. Second, of course, the impact of the crisis is quite severe on the economy and also on the financial system. But regardless, the third key message is that financial sector is quite well prepared and it is well positioned to withstand this crisis without significant challenges. Now, to come back to the key risks, as you rightly mentioned, the first risk is the duration of the pandemic and its impact on the economy. Of course, this all depends on the adoption of vaccine. There is a lot of uncertainty around this question. In our base case scenario, we expect the vaccine to be adopted in the first half of 2021, but in an off chance that this process is delayed, the 2021 will also be a difficult year for the world, but also for Georgia as a small open economy.
Also, there is increase in risk premium and also the negative impact on exchange rate and also the debt. Is it what we are looking at the situation right now? And also, I remember when Mr. Gwenetadze himself, head of president of the NBG, said that there is this kind of dilemma when on the one hand, of course, all these support packages have this impact on lari exchange rate, but also it is very necessary to support the vulnerable groups, especially during COVID-19 period. Do you have enough instruments to kind of try to monitor this process and manage this process?
So far, what we are seeing, the risk premiums have not increased for Georgia materially. But if this is the case, this may withdraw the capital from the country and may impact the foreign exchange rates. The dollarization of Georgian financial sector is quite high, which means that the borrowers are borrowing in foreign currency. Of course, if lari depreciates further, this will impact the credit worthiness of these borrowers. On the other hand, today the National Bank of Georgia is well prepared. Our reserves are at adequate level, and we are spending, and we will continue spending foreign currency to support local economy with more liquidity in foreign currency.
The next risk is a decrease in external demand and also some kind of lockdown perspective, so to say, and the impact on tourism and of course other sectors that are also connected with tourism. What do you mean under more than expected tougher negative impact, and what are some of the factors that may be playing?
Yes, so this risk primarily assumes further travel restrictions. Georgia was highly dependent on tourism in 2019 and previous
and service sector
years.
in
of
general.
Of course, related service sectors are also impacted. and we have high employment in these service sectors. If there are further travel restrictions and tourism inflows reduced, this will have impact not only on current account deficit, but it will also impact the employment in the country. Both will have impact on the financial sector.
And the final risk that is identified in this document is price decreases in real estate due to the weak demand and the negative impact it might have on the financial sector. What is the correlation here, and how does demand in real estate correlate with the financial stability?
In this case, it is important to draw a parallel to the previous crisis, where we entered the crisis with a price bubble. So in 2008-9 there was
financial crisis.
Yes, so when the financial crisis started, there was a real estate price bubble, not only in Georgia but across the world. This time, this is not the case. So even though we had high growth in this sector, mortgages were growing well. The prices of the real estate was not significantly increased. This means that we don't expect as severe shock on the prices of real estate as there was in 2008-9. Though if there is a shock on real estate prices, the channels how it affects the financial sector is double. First, of course, the direct exposure to the sector is high, of the financial sector, so they're funding the real estate projects. But in other sectors, a lot of the collateral is provided with the real estate, and of course, if the prices of real estate will drop, this will impact the credit quality of other loans as well.
Now we see in this COVID-19 period that government is trying to support this sector as well, and mainly this is the well-known subsidy program. So how does that impact the risk itself?
Currently, of the mortgages disbursed, about 35% is attributed to this program. So 35% of mortgages are disbursed through interest rate subsidy program. We expect that over time, the natural level of demand should increase, and the impact of the subsidies should decrease, and these two factors should balance each other in the medium term.
You mentioned the key phrase, we expect. So what are some of the scenarios that are associated with the risks that we have been mentioning above, and where do you put on this scenario map Georgia at this moment?
We expect, in all these cases, we expect broadly three types of scenarios. First is a base case scenario, then we have risk scenario, and we have severe risk scenario. In the base case scenario, we expect 5% reduction of GDP in 2020, and then 5% recovery in 2021. And of course, this macro assumption is accompanied by assumptions on other factors such as real estate prices, exchange rate, interest rate, and so on. In the in the risk scenario, we expect the pandemic impact to be longer and vaccine to be adopted in the second half of 2021. In this case, the recovery process will be much slower, and also the impact of 2020 growth will be stronger. We expect the GDP reduction of 7% in this scenario in 2020 and 2.5% growth in 2021.
So the pace of the growth is also slowed.
Yes, pace of the growth is also slow. And in the most severe scenario, we expect not only the timing of the vaccine to be longer, but also the impact of the crisis to be stronger throughout this period. And in this scenario, the GDP decline will be 9% in 2020, and we will only have 1.5% recovery in 2021.
Let us hope that the severe scenario won't take place. Thank you so much for being with us and taking our questions.
Thank you for inviting me.